So if the counter argument to people like you say that we're going to have sticky inflation for a really long time is that if we get a big recession, that does cure inflation. So are you saying that you're not expecting a big recession in the U.S.?
I am not expecting a big recession in the U.S. We have to offset that. We have 3 giant fiscal stimuluses that were created in the last 2 years that are starting to enter our economy. That's the infrastructure bill. That's the CHIPS Act and the IRA. The culminated of those 3 bills are $1 trillion of stimulus over the next few years. Think about how many jobs infrastructure creates. Think about the demand for commodities as we build infrastructure. And so yes, you're right. We have some sectors of the economy are starting to weakening, but we are going to have other segments of the economy because these tremendous fiscal stimuluses are going to offset some of that. And that's just beginning. Those stimuluses are just beginning to enter the economy right now as other components are slowing down. So, no, I don't see a big recession. I'm not even sure we're going to have a recession in 2023. We may have it early 24. It really depends on what is the pathway of inflation in the short run, what is the pathway of the Fed, and also, more importantly, how does this all play out in terms of credit and credit spreads, and what is that impact on regional banks and other asset owners?
Well, let's go back. 1 month ago, we'd sit here, and there were actually people who would come on and talk about the Republic being in danger, not Republic Bank.
The country, yes.
Now, how did we get to a point where a couple of banks failed and everyone suddenly felt that the system was as weak as it was in 2008?
Well, I think they were wrong. I mean, we have, yes. When you have a 475 basis point movement in 18 months of interest rates, you're going to expose risk takers who took too much risk. That is not systemic. We've had a few banks that had hyper asset growth in 2020 and 21. Those all you have to do is look at who had the hyper asset growth during 2020 and 2021. And so that means they took on a lot of mortgages at 3.5%. They took on a lot of assets at the lower interest rate. Now, the bigger question is not everybody who had hypergrowth then failed because they probably matched their assets and liabilities. But those who did not look at they made a lot of money because the interest, they were paying very low short rates and earning the 3 3/8. Well, now they're paying 5+% and earning 3 3/8. And so they have, that's the problem. But this is not a systemic problem. This is not a problem that is going to impact, as we saw today. We had our big banks having great quarters and performing really well. And so I think this is just an example of, when the tide goes out, some people are going to be left there.
But Larry, there was one part of this that was distinctive, which was the rapid disappearance of deposits in a matter of hours.
Yeah.
42 billion. I've said this number many times in 4 hours.
Yes.
SVB. I assume that got your attention. I'm just curious as to whether you think it's sort of an existential question for some of these banks.
I think it's going to be a bigger existential question as what do banks do with their held-to-maturity account? Right. I think that's what the real issue is. We use held-to-maturity more in this country than in most other countries. Actually, in most other countries, banks do more floating rate lending than fixed-term lending. We're able to do more fixed-term lending and put that into a held-to-maturity account. What we have seen, and we've never seen this before, is the market's looking through to the mark-to-market impairment, and they're saying, "Oh my gosh, this company may be impaired. And then you have the deposit flight,
and they fly a lot quicker than they used to.
So that's the bigger question: is what is the value of held-to-maturity? How should banks be using that? So does that mean the banking system is going to be more engaged in lending floating rate, less fixed? That to me is one of the big existential questions to ask. Does the transparency of held-to-maturity now mean we're going to see different outcomes with banks to minimize that outflow in liabilities? The outflow in liabilities is a great reminder that this money is overnight money. Okay, so it is a reminder, and seeing $42 billion out in 4 hours is a great reminder how quickly things can turn. The result will mean is more and more institutions will probably shorten their asset and liability match, making sure it's more matched. But does it beg the question is, how are they going to look at held-to-maturity going forward? And I think we have not spent enough time and asked ourselves that, what is the value of held-to-maturity if the capital markets are going to look through that and mark-to-market it?
Right.
Because for regulatory purposes, you don't have to mark the market. And I think that was one of the big issues related to the supervisors of that institution.
Yeah, we talked about that.
Because it was an account that was a commonly accepted accounting rule that if you deem this asset to go into a held to maturity, that you don't have to mark the market. But yet now the capital markets is now looking through that and saying, no, we want to know what's really going on in that one giant pool of money.
And you're right, capital markets. You use a great phrase here. You say this will further accelerate capital markets growth. This
Correct.
is happening, and it's not been recognized until I read this in the piece.
And that's my point. I mean, we have a backdrop. We have the most developed capital markets. We're sitting in the bastion of capitalism here at the New York Stock Exchange. We are benefited by having this robust capital markets. And so, in actuality, very few people missed the beat during these failures because so much money had the ability to run from there and put their money safely. That's a good outcome. Now, the question is, though, from a BlackRock perspective, we need a healthy banking system. And we need a healthy capital market system.
Right.
And that's what we need. We need a good mixture. But you're going to see when the one segment of that segment is in distress, like we saw, you're going to see more money flowing into the capital markets. And that may reverse one time, too. And so we do have the most healthy financial system of any country in the world, and we should be proud of it. We should not look at this with extreme negativity. We should look at this, my gosh, we had those safety valves, and it worked.